Hey everyone, how about those Viatris earnings? I'm here at Stanford University at the Stanford Cactus Garden, my alma mater. I've even got my alumni hat right here. And I just wanted to celebrate the incomparable Viatris earnings. And the reason I'm doing this video intro here is I want to drive home the message that it's really important as dividend stock investors to believe in ourselves. I put in the work, I put in the analysis. A lot of skeptics were saying, hey Ian, Viatris is not a good stock. Hey Ian, Viatris, the PE ratio, it's not really 3. But the Q1 earnings report that came out today, as I'm going to demonstrate in the video today, the PE ratio, in my humble opinion, really is in the 4 range now because the stock has gone up a little bit, but it was in the 3 range where I first started buying based on data that's coming out of the company right now. And this company surged in price today, but I'm still buying shares. I bought more shares today in the $15 range, and so I want to talk about that in the video today. But as a Stanford alumni, as someone who put in the work, it's really important as we all go through life to put in the work, to put in the hard hours of analysis, but also to trust in ourselves. And I'm so proud that I trusted in myself, and I'm so proud how well my Viatris stock pick has turned out, but I still believe it's a deep value dividend stock. And so I'm going to get into that in the video today. I hope you really enjoy today's dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, I'm excited to be back here at home, and I want to share with you some analysis that I performed today on Viatris. First, I want to get through their earnings report, so check it out on the screen right now. This is what they released for their Q1 earnings, and basically what they said is total revenue was $4.4 billion, and they had a net loss of $1.0 billion on GAAP basis, generally accepted accounting principles, although that's just because, in my opinion, that it's a brand new company. It was formed by Upjohn spinning out of Pfizer, combining with Mylan. There's a lot of costs associated with that. There's a lot of accounting associated with that. And over the course of the next year, things are going to get figured out. There's going to be a lot of synergies, and that's exactly what I see as I go through these numbers. And so they had an adjusted EBITDA of a positive $1.6 billion. They had a U.S. GAAP net cash providing by operating activities of $849 billion, free cash flow $799 million. And what investors particularly loved is they did go ahead and declare a quarterly dividend of 11 cents per share as expected, and they generated $163 million in new product revenue in the first quarter. And so a lot of things are going really well for this company. They are expecting $500 million in synergies throughout the end of 2021. And Wall Street was really surprised and excited with this news. As I dug even further into the numbers, I found even better news, so I want to keep going. Before I do that, check it out on the screen right now. What you can see is how the stock performed today. Viatris stock performed very well. I went ahead and I purchased more shares at 15.07. As soon as I bought the shares, it went up even more, and so I was really excited to see that, although it did close today at 15.04, so a little bit lower than where I bought. Personally speaking, I'm going to continue to acquire shares in the $15 range, and you'll see later in the video why I still feel comfortable in the $15 range, but it's at 15.04 right now, which places it at a market capitalization of about $18.18 billion. And so just because this is a channel about investing for cash flow, for dividends, I want to share that great news once again. Check it out on the screen right now. And what you can see on the screen is, in terms of capital allocation, the board of directors declared a quarterly dividend of 11 cents. They also said that they paid down $1.06 billion in short-term debt, and they're going to continue to target approximately $6.5 billion of debt repayment through 2023. One of the things that's so important about this company that has investors a little bit thrown off, that has investors a little bit skeptical, is the debt load. But it seems like they're going ahead, they're keeping the dividend payout ratio pretty low so that they can go ahead and repay debt. So I'm really happy to see that. And I even saw that as I was looking at their balance sheet. I'm already seeing the debt tick down. And so I'm really excited to see that. And quite frankly, in my opinion, fiat currency here, the dollar, global like fiat currencies, I don't think they're very valuable. I think that they're going to be continued inflation here. And so the fact that they have a lot of debt doesn't quite mean as much as a company that had a lot of debt maybe back in the 1990s or something, when inflation wasn't so bad as it is right now. But inflation is high, interest rates are low. They have a lot of debt, but they're going to figure out a way to pay it down. And I think a lot of people are ignoring the stock because of the debt. I am going all forward on it because of the debt, because that's throwing everyone else off. Now with that, I want to show some of their cool products. Check it out on the screen right now. You've probably recognized a few of these before, but you can see they're global products that have very large sales. These are generic prescription drugs. That's what they do. They focus on generics and biosimilars, and these are drugs that are off of patent protection, and that's how they make their money. So you can see some of the big brands that they have right before your eyes. Now, with that, I want to keep going. I want to share some of the financials, and then I want to get into my financial analysis. So check it out on the screen one more time. And so what you see in front of you right now is their non-GAAP reconciliation. And so this is really important, because what I'm looking at when I analyze this company is the adjusted net earnings. The net earnings on a GAAP basis, generally accepted accounting principles, is completely thrown off right now. It's thrown off because of depreciation related to the whole financial process that created the company. It was basically a spin-off of Upjohn from Pfizer combined with Mylan. There was a lot going on, and that created a weird GAAP accounting for it in the short run, and I think that threw off a lot of people. But for me, I'm looking at adjusted earnings right now, and I think the adjusted earnings over time will be closer and closer to the GAAP earnings. But right now you can see the GAAP was a loss of $1 billion in the quarter, but on an adjusted basis they earned $1.1 billion in the quarter. And you can see, quite frankly, that a lion's share of what was happening there at that loss was purchase accounting related amortization, primarily included in cost of sales. And so again, I think this is related to the Upjohn spinoff Mylan merger. And you can see another big item in there is restructuring related costs. Well, restructuring is a one-time event as it pertains to the spin-off and the combination with Mylan. And so you can see in there, there's some other special items, so on and so forth. There was a big bucket in there for tax effect of the above items and other income tax related items. And so what they're basically saying as a company is there is a lot in flux right now as they restructure the company. They form this new entity that was the combination of two prior entities, and they're seeing on a non-GAAP basis that they actually earned $1.1 billion in a single quarter. Now keep in mind that this company is only trading at a value in that 18 billion market cap range, and keep in mind that this 1.1 billion they earned on an adjusted basis is only one quarter out of a 4-quarter year. And so with that, I want to go into my financial analysis and why I'm so excited about it. So check it out on the screen once again. And what I want to go through is my Excel analysis. Now, what you see here is an Excel analysis that I will share on Patreon for those patrons who are at the $10 level and up, basically the Thug Life Investor patrons. You will get this analysis. And so thank you so much for your support on Patreon. And if you're not on Patreon yet, please do check it out. I have over 30 videos on there, and Patreon starts at $3 per month. It's really affordable. You can cancel at any time. There's 170 or so dividend investors already over there enjoying these videos, the community, the analysis, the opportunity to message me on there, and it's a really good deal in my humble opinion. For only $3 a month with canceling at any time unlocks those 30 plus videos right away. But if you want the extra analysis on there, that's at the $10 a month level. Anyway, what you see here right now is just a summary of their numbers from Q1. They have the 4.4 billion revenue, GAAP loss of 1 billion, adjusted net earnings of 1.1 billion. I highlight that in yellow because it's such a special number. They did really well on an adjusted net earnings basis. Adjusted EBITDA, which is earnings before interest, taxes, depreciation, amortization, was 1.2 $2.6 billion. I like the adjusted net earnings better. That's what I look at because it's after taxes and interest. Now, they have a net cash from operating activities on their statement of cash flows of $849 million, free cash flow, which is after capital expenditures, of $799 million. But the free cash flow is before they pay down debt. Quarterly dividend of 11 cents. And so, as expected, they have net new product revenue of $163 million. Some of this is repeat from that first slide that I showed you, so I'll go really quick here. One thing I do want to show that is not on that first slide is the interest expense is only $169 million in the quarter, so not too bad. They've got a lot of debt, $22 billion of long-term debt, which is down from 22.4, so they have 22.1 versus down from 22.4. And so what you can see here is just a quick PE ratio projection. What I basically did is I take their market cap of $18.6 billion. I take their adjusted net earnings in Q1 of $1.1 billion. I multiply by 4, that gets us to $4.4 billion over the course of a year, assuming that their sales are relatively steady by quarter. My forward PE projection, which takes the $18.6 billion market cap, I divide by the net earnings of $4.4 billion, I'm getting a PE ratio, even though it's appreciated in price here a little bit, of about a 4.23. Now, this is a very similar PE ratio projection that the analysts are getting, because you can see right below on the Viatris stock metrics that the price per share is $15.04. The analysts are expecting $351 this year, $365 next year, and so they're getting a forward PE of 4.28 this year, 4.12 next year. And so what I wanted to say is that the analysts are seeing a very similar PE ratio projection range as to what I'm seeing. Now, I have a quarterly dividend there of 11 cents, annual dividend of 44 cents, and so that dividend yield right now starting is at a 2.93%, but it's only a payout ratio of 13%. There's a lot of room to increase the dividend over time, especially once they pay down debt. I think once they pay down debt, they could get that payout ratio up quite a bit higher. I think maybe even to say 40% over time. And so what I want to do next is just close out with a few more metrics that I analyzed. I'm so excited to share with you. So check it out on the screen once again. And what you can see here is I have some income statement analysis. I'm just showing margins. Their revenue was $4.4 billion, but their adjusted net earnings were $1.1 billion. That gives a net margin of 25%. That's actually a lot better than I would think with a generics and biosimilars business. And so that's really exciting to see. And I just want to show a quick projection on what I think could happen with this stock over time. This is just my personal opinion. It may not be correct. It's certainly not financial advice. It's just my personal journey I'm sharing here on YouTube. But I think the price per share could probably double from here, get to about $30 over time. I think the EPS will be pretty stagnant. I don't think their business is going to grow that quickly. It's a generics and biosimilar business. It's a tough business. Thankfully, they've got some good margins on that tough business. But I think, just for my own conservative projections, I would say the EPS stays around that $3.50 range. Which is pretty stable over time. And so I think the forward PE, though, over time, as there's more visibility around the business, there's more comfort with the business, they pay down debt, more people understand the business, there's not so much skepticism, there's not just a lack of data. I think that the stock will trade around a PE of 8.5, and so that's what it'll have at a price of $30. I think that their dividends per year over time will go up to about $1.40, which would be a dividend yield of 4.7%. And the way I get that is I just think once they pay down debt, I think their payout ratio will be closer to 40%. And so also what that stipulates, though, what's so exciting is if their dividend can get that high, I'm buying it right now at $15.04, and I bought shares lower. I bought shares lower than $15. And so my dividend yield on cost, simple yield on cost, not including reinvested dividends, would come out to a 9.3% if all of this happens. And so one of the biggest things I think with Viatris is it's kind of at this point so early in the game. It's a first mover advantage. It's a spin-off that no one understands. A lot of people don't like the debt, but quite frankly, I'm not so worried about the debt in the environment we're in, where fiat currency is inflating out of control, and they're going to pay it down, quite frankly. And I think also they sell more affordable products, generics, biosimilars, that are a lot more affordable than buying the brand name prescription drugs. And so I like the fact that they're going in towards more that value segment as well within the market. And they've got some heavy hitters in their portfolio, as I shared with all of you earlier. So if you enjoyed the video today, I kindly ask you to smash that like button. It really helps me out here on YouTube. I'm doing this extra video here today. I'm doing it impromptu because I want to share with the community in real time what I'm seeing with this position, Viatris, that I'm really excited about. And also, please don't forget to subscribe. I have a lot of content on the way, both here on this channel, my dividends channel, and also on my crypto channel, which I'll link to in the description in the pinned comment below. Please subscribe to both of those because I have new content coming out all the time. And so I have some exciting stuff I want to share at the end of the video today. I was at the Stanford Cactus Garden earlier today, as I shared in the intro today, and I have some really cool video footage from it. And so if you want to see some of that video footage, wait till the end. I've got a really cool video that I produced there as well if you want to check it out. Before I get to that, though, in terms of a full disclosure, I am long Viatris, ticker symbol VTRS. I'm also long Pfizer, ticker PFE. Also, in terms of a friendly disclaimer, this is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out, invest in the stock market or anywhere else, please consult your licensed financial advisor first. Just sharing my journey here on YouTube, on Patreon, so on and so forth for fun and entertainment. And please put in the comments below what you think about Viatris. Do you think it's one of these kind of hidden gems, if you will, like I do, that's just kind of no one's quite figured out yet? Or do you think it's a loser? Let me know in the comments below. Personally, I believe that one of my edges in investing is I'm willing to move without complete information. I moved before this earnings report was even out. That's how I scooped up shares even cheaper. But I still think there's a good level of skepticism out there where I still believe it's a hidden gem. And so I think my edge in the market is sometimes moving before other people have all the data, and certainly before institutions feel comfortable moving on certain stocks. And so I kind of embrace my inner Peter Lynch on this one. All right, everyone, I love you all. I'm going to roll the footage from the Cactus Garden before I leave today. And so hang in there, and I'll see you in the next dividend investing video.
Bye.